Made Simple. Today, I want to introduce you all to three of the core concepts that we use here at Sectors Made Simple. While this might be a review for some, I feel like it's really important that we go back to basics sometimes and share what are the basic ideas that we are building off of. Sectors Made Simple has been around for years, and through that time, we have gone from having a very basic idea of what areas of the market are performing the best, up to tools that allow us to find swing trading opportunities before they even happen. But from the most advanced ways to use our tools, all the way to the simplest, three core concepts are applied almost everywhere. So I want to share those three concepts with you, talk about what they are, and then go through some examples of using them and seeing how they apply to our tools. So we're going to talk about three ideas and show how they can be used in an endless number of ways. Behind the scenes here at Sectors Made Simple, we do a lot of work. We analyze tens of hundreds of thousands of charts every single day, and the goal is to make investing simpler for you. But it does help to know what are the ideas that we're using to bring all of that information to you. So all of our tools and strategies will use some combination of three basic ideas: sectors, relative strength, support, and resistance. These three ideas can be used in so many different ways, and many of our tools rely on using these ideas in slightly different manners. So I want to introduce you to those three concepts, explain each of their benefits, and we're going to show an example of how these three ideas come together using our matrix strategies, and then we'll actually go to the dashboard and explore it with some of the tools as well. Now, let's get the big part of this out front. Why should you care? Why does it matter that you are learning these three concepts? Well, I've got three answers for you. The first is it simplifies our tools and strategies. When you're first looking at our tools, while strategies give you an actionable way of using the tool, it doesn't really take you all the way to being able to understand that information and how to use that tool itself. So we do a lot of analysis to give you these easy tools. But by learning these concepts, you learn the why behind these tools. Suddenly, how these tools work is not magic. And while the magician does show you their secrets, understanding the work that's going into it is so much more powerful. The second is that you get a lot more value out of the same tools. While we do our best to teach you about trading strategies and follow these steps to find this information with our tools, as we get further into our investing journey, it's not just about learning a new strategy, because most of the time you're already going to have strategies that you're using and that work. So the other side of that is that you currently have a strategy that you're using, and it takes you a certain amount of time to do. By learning these three core concepts, you understand more about what information these tools offer, and you can discover how these tools can be used to save you time in the strategies that you're already trading. And then finally, as much as I'd love to say that we created these three ideas, we didn't. These are three basic principles of investing. And while we have taken these ideas and seen how many different ways they can be used, the knowledge of these three concepts will apply to more than just Sectors Made Simple. It will help you find opportunities in the market regardless, and it will help you have more context for how and why stock prices change over time. Let's dive in with our first subject: what is a sector? Of the three, this is probably the most basic one, but in my opinion, is the most valuable one. A sector is a way of grouping companies based on what those companies do. In total, there are 11 different sectors, and every company in the stock market belongs to one of these 11 sectors. The reason that sectors matter is because typically, companies within the same sector will move up or down in price together. According to a study done by Investors Business Daily and their founder, Bill O'Neill, around 50% of a stock's price changes is not due to the company itself, but instead is due to the sector or industry that company belongs to. So, if we can learn what a sector is doing, if it is going up or down, that's already half the battle. So instead of needing to look at thousands of companies, or if we only looked at the S&P 500 companies, we can look at 11. We can look at 11 sectors. We're not skipping out on anything, but about 50% of a stock's price movement will be because of those 11 sectors, making it way easier to understand what direction the stock market is moving, what type of company is doing the best right now, and what type of company might be trying to catch up or is falling behind. An analogy I like to use is to think about sectors as the weather and an individual company or companies as people. If the weather is raining, chances are most people are going to get wet. Some of them remembered to pack their umbrellas. Others got out of their car thinking that they left the umbrella in the trunk, just to realize that it's somewhere in their house. So, if it's raining, while not everyone is going to get wet, there's going to be a lot of people that left their umbrellas at home or decided that they're going to go play in the rain. As I mentioned, there are 11 different market sectors, and every company belongs to only one of these sectors. Here are a couple examples. We have the technology sector, which includes companies that are involved with computers, solar, and semiconductors. Second, we have utilities. These are companies that are responsible for producing and supplying water, gas, and electric. And then finally, we have energy. These are non-renewable energy sources, being gas, uranium, and coal. I need to refresh the presentation really quick. There we go. Now all the images are synced up. For some reason, my PowerPoint, the images and the slides can sometimes get a little bit jumbled. Now, that is what a sector is and how we can group companies into sectors based on what they do. And we mentioned that one of the biggest values of sectors is that a large chunk of a stock's price and their price changes are because of the sector itself. So, if we can find that useful information, if we can learn what sectors are performing the best, there's going to be one question you're going to ask. If I find a good sector, can I invest in the sector? The answer is yes, you can. The easiest way to do that is through something called an exchange traded fund, or ETF for short. ETFs are a type of fund, which means they're like a basket of different stocks. By investing in that ETF, what you're actually doing is you're investing in all of the different companies within that basket. So, if we had the technology basket or the technology ETF, what you're really buying is NVIDIA, Microsoft, Apple, Qualcomm, Intel, and so on. Now, the really cool thing about ETFs is that, as far as we're concerned, they work just like a normal stock. They have a ticker symbol, which is their nickname essentially, and you can go to your broker and ask that broker to buy you shares of that ETF. That ETF will go up and down in price throughout the day. You don't need a special account, or you don't need a minimum deposit to get involved with an ETF. You go to your broker and you can buy the ETF and then hold it alongside other stocks and companies as well. That is the first idea, or the first building block, are sectors and ETFs, or is sectors and ETFs. The second one is relative strength. Relative strength is a way of answering the question, which company is doing better, A or B? Instead of trying to do something where we just look to see which one has made more money in the past 2 days or 5 days, instead of looking at which company made more profit, we can try and get a little bit more accurate information. What better way to find which price is performing better than to compare the two prices against each other? And the easiest way to do that is to create a relative strength price, which is just the value of A divided by B. For some reason, my PowerPoint decided to go back to things being a little bit out of sync, so I apologize moving forward. We're gonna just have to work with it. So, as I mentioned, relative strength we can think of as the value of investment A divided by B. So, if investment A was, let's say, $10, and investment B was $2, 10 divided by 2 would give us a relative strength value of 5. Now, this isn't $5. This isn't 5 cents. This isn't 5 shares. You can't go out and buy the relative strength of A compared to B. But what you can do is take that relative strength value and see how it changes over time. Because relative strength is always going to change, because the stock prices are changing, meaning that that A divided by B number will go up and down. If relative strength is increasing, let's say our relative price went from 5 to 7. That's like saying the top number is going up faster than the bottom number. Or investment A is going up in value faster compared to investment B. Or in other words, investment A is currently performing better than investment B. With the late image. The opposite is also true. If relative strength is decreasing, let's say our relative price went from 5 to 3. That means that the top number is going up slower than the bottom number. Or investment A is going up in value slower compared to investment B. Or investment A is currently performing worse than investment B. I want you to notice something, because if you really want to dive into the relative strength rabbit hole, this does matter. If you just want to know what it is and go on the little sightseeing tour and then take a right turn and not have to think about it as much, this might not matter as much. But I do want to say it regardless. When we are doing relative strength, it is A divided by B. A is weaker or stronger than B. We are always looking at how investment A compares to investment B. Again, down the relative strength rabbit hole, it is possible that investment B compared to investment A can have some different results, because now we're doing the price of B divided by the price of A. But in general, things will usually follow the same rule. We are always looking at A compared to B. Now, this idea works really, really well. It lets us compare two different investments to find which one is doing better right now. It doesn't matter if they're the same price or wildly different prices. We can compare any two investments. But there's one pretty big limitation. Relative strength does make it possible to compare two investments. But what happens if we want to compare 3? Or 10? Or 11? Or 500? Well, now we need something different. Thankfully, though, we don't need to start from scratch. We can take what we've learned so far about relative strength and how we can compare two different companies and combine it with another idea that we're probably familiar with. Sports. It doesn't matter what sport you're interested in. Football, American football, or the rest of the world football. Hockey, baseball. Typically, any sport is going to have a winner and a loser, and a way of deciding who that winner is. That idea, the process, the question of figuring out who is the best team out of this group, is what we really want to find out. Let's talk about that. If my goal is to find the top team out of a group of teams, let's say we have 4 teams in a league. What we can do is have each team play the other 3 teams. So let's give them names. Let's have team A, B, C, and D. For team A, if I want to figure out how good are they compared to the other teams, I'll have them play all 3 other teams. So when team A plays team B, B wins. When team A plays C, A wins. When team A plays team D, A wins again. So that gives us their record. And we would see that team A had 2 wins and 1 loss. We're going to just drop the number of losses here because we'll assume anything that wasn't a win was a loss. What we can do now is count up the number of wins that each team has. So while team A won 2 of their matches, we got to remember that team C is playing all the other teams. Team D is playing all the other teams. And team B is playing all the other teams. And team B won all 3 of their matches, all 3 of their games. So, while team A did have 2 wins, it's team B that would take first place with 3. This sports idea applies to almost every single sports league. You want to figure out who the best is from the group? Create 1 versus 1s and every combination of those. Figure out how many wins each person or each team had. That would be, and then add up the wins. That would be the best team. But how does that work for stocks? Because instead of teams, we would have companies. So what we can do is take each pair of companies and have them go head to head. So we would have something like company A go up 1v1 against company B, against company C, against company D. And we would figure out which one is winning, and then count up the number of wins that each company had. Pretty simple, right? Well, there's one question that still remains. Because when it comes to soccer, football, how do you figure out the winner? Well, it's whoever had more goals. But how do we decide which company is winning? Well, we need to figure out a way to do that. And that's where our third concept will come in: support and resistance. But before we get to support and resistance, I want to talk about a really important theme within support and resistance: trends. A common way to think about how the price of a stock is changing over time is through a trend. Is the trend going up? Is the price generally going up? It might have little bumps along the way, but if we tried to draw a straight line, would that straight line be going up? Or would it be going down? And somewhere in between those two, an uptrend and a downtrend, there has to be a point where one trend stopped and the other one began. I'm going to try and refresh the presentation here because this slide would make a lot more sense if it was timed correctly. I believe in you. All right, I think we're good. So, figuring out where trends stopped is extremely important because they turn around at a certain price. For example, what we see above here is the price being in an uptrend, going up to $100, and then once the price hits $100, we have a reversal, where now we go from an uptrend to a downtrend. Now we're in a downtrend. The price is generally going down. It hits a bottom, let's say $80, and then reverses again, back into an uptrend. This creates a cycle. Uptrend, a top, reverse into a downtrend, bottom, reverse, up. Basic idea, we have an uptrend, a reversal, a downtrend, a reversal, an uptrend, and the cycle repeats. This is the whole idea behind following trends. It's figuring out where does one trend stop, another one begin, and at what price. So, how can we use this information? Well, we can use it with support and resistance. In the world of investing, these reversal prices, where one trend stopped and another one, the opposite trend, began, that point has a name. But what its name is depends on what direction we're moving. If that barrier, if that price where an uptrend stopped and a downtrend began was a ceiling, it would be a resistance barrier. If that barrier was a low where a downtrend stopped and an uptrend began, that would be the floor or a support barrier. At any time, a stock will always have a resistance barrier and a support barrier. Those points are where the previous uptrends and downtrends stopped and changed direction. Now, here's the really interesting. Once we have that resistance barrier get set, for example, the price goes down. And then all of a sudden, it tries to go back up, and it starts to get close to that resistance barrier once again. And as we do, something really interesting happens. Because as the price approaches either support or resistance, investors start to pay attention. And of course, investors are cool, calculated. They think off of nothing but numbers and what makes sense. Who am I kidding? They're sitting there, biting their nails, panicking. Is that just me? Anyway, we do see that investors start to pay attention and they start to ask a lot of questions as they get a little bit more worried. because the last time the price got up to $100, it went down. I don't want to lose my money. I already made some profit. I'm going to just sell. Well, is it going to go down again? Should I sell early? Should I wait? All of these questions start to go through people's minds. And that's the reason why support and resistance matters. Because it is very common to see a stock's price reverse at or close to its resistance or support barriers. But there's still one bigger, more important question that we need to ask. What happens if the price comes up to that barrier and then doesn't stop? That is what's known as a breakout or breakdown signal. When the price goes beyond support or resistance, another way to say that would be if the price breaks below support or goes above resistance, we call these a break or a signal. If we have a price go above resistance, that would be a breakout signal. If we have the price go below support, that would be a breakdown signal. Now, that is support and resistance in a nutshell. It tells us two things. It tells us the current trend. Is it an uptrend or a downtrend? And it helps us to find those signals. Is the most recent signal a breakout, the price going above resistance, or a breakdown, price going below support? Now, let's take what we've learned and go back just a little bit to relative strength. Because now we've got two new ideas, right? We've got our direction. Is the price going up or down? Is it in an uptrend or a downtrend? Another way we can think about this is its short-term trend. Because if we want to go from an uptrend to a downtrend, all we need is to just push it over the edge just a little bit. Pretty easy. Then we have our breakout or breakdown signals. Is the most recent a breakout or a breakdown? These take a little bit more work because now not only do we need an uptrend if we want to have a breakout, we also need that uptrend to go above the previous high, the previous point where an uptrend stopped and reversed. So, because it takes a little bit more than just a little nudge, we can think of these breakout signals or breakdown signals as long-term. So, we have short-term, which is the direction, and long-term, which is the signal. So now, let's go back and see how we can compare two companies against each other. If we take our two companies, A and B, we can see who is winning through those two different methods. Who's winning short term, which is just, is the relative strength chart in an uptrend or a downtrend? And who is winning long term? Is the most recent signal a breakout or a breakdown? This is the way that we can figure out the winner from two companies paired together. So, let's bring it all back together and figure out who the leader is from a group. Because now we've got all the pieces we need to find that out. We can find that winner using our two different ways. We can find the short-term winner and the long-term winner, because for every single comparison, we will have a winner for both. Now, that winner might be the same, but it might not be. So we figure out for each pair who is the winner for short-term and long-term. We repeat that for every possible combination of companies, and we add up their number of wins. Now, a little bonus step that we do is that instead of just looking at short-term or long-term scores, we want to create the one number to rule them all. So we can take the short-term wins and the long-term wins, add them together, and get our overall or our total score. That overall score, if we rank the companies based on the highest to lowest number of wins, that would give us our strongest company. Now, you're probably already starting to see how these ideas all play really well together. But let's be a little bit more detailed. Sector and sector ETFs. These are the what we're comparing. Relative strength helps us to find out who from that group is the strongest or the weakest. And how do we decide stronger or weaker? Well, the how is support and resistance. So who are we, or what are we comparing? Sector ETFs, relative, or who is stronger or weaker? Relative strength. How do we figure that out? Support and resistance. I want to wrap this up by looking at how these three ideas can be used together to create something very simple. Matrix strategies. Matrix strategies, if you're not familiar with them, are probably the easiest way to get started investing with sectors made simple. Because all of these strategies are automated. We don't need to do any setup. We don't need to do anything. We look at the strategy and it says, I'm buying this. And also, these strategies only update once a week. So once every week, these strategies will do some stuff and decide what they want to buy for the upcoming week. They trade once per week and only trade one thing per week. So when it comes to learning a new strategy, finding out a way to invest, how does it get easier? You only need to look at something once per week. It tells you in plain letters what it's buying, and we take it a little bit further, and we also show you how well that strategy is doing. So you understand what the strategy is trying to do, what it's buying, and also the real numbers to tell you how well that strategy is actually performing. So let's see how our three building blocks come together with matrix strategies. Each strategy chooses one sector ETF to invest in. It is picking from the 11 sector ETFs plus a 12th, which is the S&P 500 ETF, SPY. Then, how do we figure out what sector the strategy is going to buy? Well, we use relative strength to compare all those sector ETFs. We want to buy the best sector? Cool. Let's use relative strength to find the best sector. And how do we do that? Well, we find each sector's relative strength score through support and resistance. At the end of it, what we end up with are those three scores. Short term, based on the number of wins that each company, or in this case, each sector ETF has. Long term, the number of long-term wins. And total, which is the short plus the long. Those are the three basic building blocks for sectors made simple. And what I want to do now is head on over to the dashboard and give you a few examples of how that information can be actually used. What we have here, if I put this back to English, is the sector summary. When you open up the dashboard, this is the first thing you would see. And now, all of these different pieces can start to come together. We see here that right now, we have our list of the 12 different ETFs. These symbols are the actual sector ETFs, and they're ticker symbols that you can go and buy. We have each sector's long-term strength, their short-term strength, and their total, which is their long plus their short-term. With the risk of making things a little bit more, here's what it looks like under the hood. I know it's a lot. It looks like a demonic game of tic-tac-toe, but bear with me. Let's take the S&P 500 SPY. Each one of these, NX, NO, PX, that is the relative strength chart for SPY compared to XLB. That chart is X, which is a short-term win, N, which is a long-term loss. So, what we can think about that as is that SPY is stronger than XLB, which is the material sector, short-term, but it is weaker long-term. SPY compared to XLC, O is a downtrend, N, once again, break down. So it is weaker than XLC, which is the communication sector, for short-term and long-term. The X is a win for short-term and for long-term. So if we wanted to figure out how many wins does SPY have, well, we would add up the number of Ps, which is a win for long-term, and X's, which is short-term. So we have 1, 2, 3, 4 Ps, long-term strength of 4. And we have 1, 2, 3, 4, 5, 6 short-term. Do you need to look at this entire game of tic-tac-toe? No. There's a reason that it is something that is turned off by default. But what I wanted to show there is that we're not pulling some numbers out of a hat and saying, trust us. What we are doing to come up with these numbers, these strengths, is just using those basic concepts. We are looking at sector ETFs. We are figuring out which sector is the strongest using relative strength, and we are figuring out wins based on support and resistance. That is how the matrix works. And this information on the matrix is what all of our matrix strategies use. So for example, our Wednesday long-term strength strategy, it trades on Wednesdays and it looks at long-term strength. That's how it decides what it's investing in. How is it done? Over the past 3 months, it's had a gain of 9.3% with a risk of 1.4% compared to the market's 6% gain and same loss. Over the past 6 months, same risk, 1.35% for 26% gain compared to the market's 17% gain with a 1.4% loss. Do you need to go through and get a PhD in relative strength to trade these strategies? No. But when it comes to looking at a strategy that we would potentially want to follow or consider investing in, I do feel like it's important that we understand a little bit of how that strategy is actually coming to its conclusions. And in fact, if you click Show Investment Steps, we give you the step-by-step of exactly how the strategy comes up with its choice every week. You can follow that manually, or you can just see what it's currently holding, set an alert to be notified when the strategy updates, and that's all you have to do. I want to give you another example where instead of looking at relative strength of the 11 market sectors, let's look at the 500 companies within the S&P 500. Now, before we do, let's start to think about this from the basic idea of taking two companies and comparing two companies to comparing 500. Because if we want to find the relative strength winner from 500 companies, that means that every company needs to play against every other company. So company A would need to go up against 499 other companies. AAPL, Apple, would need to go up against 499 other companies. If we go back to our matrix, this is how many charts it took to make a relative strength comparison of just 12 things. For those that don't want to count at home, I don't blame you. 132 charts. We did 132 charts with relative strength to find which sectors have the highest and lowest strengths. The S&P 500 matrix, the reason that we don't even have that as an option is we couldn't figure out a good way to show you 249,500 charts that we calculate every single day. But who's counting? What we end up with, though, are the same three pieces of information. What's its long-term strength? Well, 77.6%. Where did our number go? Well, our number is still there. That number is actually a strength of 388. And it's out of 499. So to make things a little bit easier, because I don't want to have to remember out of 499, and then total, because it's the two combined, 998. Ugh. Percentage. A is beating 77.6% of S&P 500 companies long term. It is beating 85.6% of companies short term. And overall, it is beating 81.6% of companies. I can work with that. And we can do that for every company in the S&P 500, where the higher their percent, the more companies out of the S&P 500 they are outperforming right now. So we've taken the same two building blocks, relative strength and support and resistance. But wait, there's just a little bit more, because you'll probably still see sector. Yeah, that sector building block is still there, but it's being used in a slightly different way now. How? Well, we are no longer using sector ETFs. So if I wanted to use sectors here, I need to use them in a slightly different way. And in my opinion, if we're looking at companies, this is the better way to do it. If I want to find what the best sector is right now, but I want to invest in companies, not the ETF, what I could do is I could look at, let's say, the energy sector. I take all of the long-term strengths and I find the average. What is the average long-term strength of an energy company? What is the average short-term strength of an energy company? And then I can compare all the sectors to see which one, on average, has the strongest companies. That answer? Sector strength averages. And we can sort these to see overall, healthcare has the strongest companies in the market right now. Utilities is in second, with consumer discretionary, these are the I wants in life, in third. Cool. That's sectors. So if I know that, for example, healthcare is the strongest sector, I want to find the strongest company in the strongest sector. Cool. Filter by sector. Now, we're back to our idea of relative strength. Which one has the highest or the lowest relative strength? All of these ideas, all of these tools, all they're doing is using these three building blocks in slightly different ways. The last part of this tool that is just a little bit off screen is another way that we can use support and resistance. Because we've shown you two examples now of doing it for relative strength, but we can do it for price too. Is the price in an uptrend? Is the price going up? Is the price in a breakout? Well, we've got that. We can see its trend, its direction. Is the direction going up or down? Well, what if we only wanted to see companies whose prices are going up right now? Cool, done. Okay, I want to find companies that are on breakouts. They're creating new highs. I don't need to worry about if there's going to be a fight over if the stock gets to create a new high or not. I don't want that. I fought hard to get that money. I want the money to work for me now. Let's find something that's already on a breakout. Cool. So now, with just a little bit of using those three building blocks and organizing them in slightly different ways, we've got a list of the top companies in the top area of the market whose prices are currently going up and are creating new highs. We only have used three ideas. We haven't looked at a single stock chart. We haven't had to think about any sort of analysis. We have just thought of some easy ideas. I want to find the best thing. I want the thing that's going up right now. And by applying one of those three building blocks, we have put together a list of the strongest companies in the strongest sector whose prices are going up and are creating new highs. Sectors made simple is not magic. But there is a lot of analysis that we do behind the scenes so that it can look like magic. Now, this might be a Santa isn't real kind of moment for some people, but magic is always about some sort of trick. But a magician never reveals their secrets, because part of the joy of magic is that you don't need to figure out how the trick worked to enjoy the trick. When it comes to investing, we can think about it the same way. Do you need to hit the show extended matrix and momentum to learn how to use the matrix or to learn how to use the S&P 500 screener? No. But at the end of the day, if you are looking at these tools as a way of investing and you do want to go just a little bit more into understanding the why, the how, to be able to use these tools for yourself, to find strategies or create new strategies for yourself. We don't need to go and buy a bunch of crazy trick bags or trick decks or learn some crazy sleight of hand. We have learned three ideas: sectors, relative strength, support and resistance, and now With those 3 ideas, we have an entire arsenal, an entire tool belt of different ways that we can use those 3 ideas to find opportunities for us in the market. Either through simple strategies that are see it, set it, forget it, finding opportunities that are emerging in the market right now, or using some tools like swing trade setups, really taking things to the final level of what is possible with relative strength, support and resistance, and sector. But that is a story for another day and another webinar. Before we wrap things up for today and all head out for Thanksgiving, I want to see if there are some questions that I can answer here live, and then we'll wrap things up. Hi, Jonathan. Do these filters not necessarily integrate with fundamental analysis, but focus only on performance? You are brilliant, Romulo. Amazing question. They can. And right there, that question is why today's webinar matters. I swear this wasn't a plant. Thank you. Yes, let me show you. So let's talk about fundamental analysis for a second. Fundamental analysis is trying to figure out what companies are strong, not based on their price, because price goes up and down. What company is generating profit? What company is growing over time? These are different things that go on outside of the price that really can matter, especially if we're looking at investing more long term. I'm investing because I like the company, not because I like what the price is doing right now. Thankfully, my mom, Julie Stav, created an amazing filter that uses a combination of fundamental analysis, all the stuff besides price, and technical analysis, which is price. And we can get quite a few pieces of Be a Profit, which is her formula for that, here in FinViz. So I do have an entire video on this, by the way, on our YouTube channel here. So if you want to go and watch this kind of broken down a little bit more, I recommend checking out that video. But for right now, I want to answer this question, and it is a fun one to answer. So let's figure out fundamental analysis. Some of the most important parts of Be a Profit are EPS growth quarter over quarter. This is a way of figuring out earnings per share. Are they making more money? Are they growing as a company? We want it to be 15% or more. Return on equity. This is a way of saying, for every dollar that they have, how much profit are they creating? We want a company that is able to take what they have and build more than what they started with. We want that to be over 15%. Now, let's add a few things from the technical analysis side. Let's add in beta, because I don't want a stock that is going to be bouncing up and down in price like crazy. Beta compares the changes in price of the stock to the changes in price on average of the S&P 500. For us, we want under 2. It can be a little exciting, but I'm not looking for a roller coaster. Also, I want their price to be at or close to its highest in the past year. Why? I want to find a good company that I can invest in long term. I'm not buying into recovery from a company. Then the last thing I'm going to add is, because right now we're looking at companies big and small, I want to limit our search here to the S&P 500 index, because we're going to come back to the S&P 500 in a second. We have 41 companies. Okay. I don't know about you. I don't want to look through 41 companies and have to make a decision. So let's go back to our building blocks. If I want to narrow down how many companies I'm looking at. I can do that with relative strength to find only the leaders, but 41's a lot to try and deal with. So relative strength probably out of the picture. I'm still only comparing companies right now. I don't care about if they're creating or if they're in uptrends or downtrends. And also there's not really an easy way to do that using FinViz. So probably not that. The third block, sectors. Oh, hey, we've got a sector column here, right? So let's go and see what the best sector is right now. Healthcare. Okay. Sector. Healthcare. I can work with 6 companies. I'm going to take a quick screenshot of those 6 companies. And now we can go back to the S&P 500 screener. And we can put in that list of 6 companies under ticker. So we got GILD. And this is what happens when you spend a little bit too much time poking around a bunch of buttons and highlighting things. So we wait for the information to load one more time, and we'll put in that list of companies. And what you'll immediately notice, we now only have one company. Because once we start to filter by ticker, we only see the companies that we're interested in. So here are those 6 companies. Cool. What do you want to do with it? You want to find the strongest company overall right now? Relative strength's got our back. REGN, I think that's Regeneron. 91.5% relative strength. But let's take things a little bit further. Remember how we could add in all of that support and resistance stuff? The uptrend and the breakouts? Now we can do that too. So now we have a list of fundamentally strong companies, which is something that we have brought in. That was our decision, our fun. And that is a great example of where learning this information can really help. Because we started with a short list of companies. We used sector to narrow down our search a little bit. And now we've used relative strength to find which are the strongest, and support and resistance to make sure those companies are in a short-term uptrend and a long-term breakout. There are so many different ways that this tool can be used. It can be used in ways that we share with you, like the example I gave to start things off here, or like matrix strategies, or taking Romola's idea of fundamentally strong companies and then putting relative strength in to make a decision between those companies. All of this is made possible through those 3 building blocks: sectors, support and resistance, and relative strength. Do you need to master the market? No. What you don't need every tool in the workshop. All you need are a few good tools that you know how to use: a hammer, a saw, and a ruler. And with those 3 tools, you can build whatever you'd like. You can follow a tutorial online to build a nice frame or a chair, or you can get creative and see where your creativity and the possibilities that are out there can take us. But I've really enjoyed getting to share these 3 concepts with you, and both myself and our community getting to share ways that they would want to see this information be used. But I want to hear from you as well. If there are ways that you would want to use relative strength, sectors, or support and resistance, and you want to see if our data at Sectors Made Simple can help you invest simpler, please feel free to reach out to me. My email is support@sectorsmadesimple.com. It's always a pleasure to be able to chat with you, hear your goals with investing, and help show you and share with you why investing can be made simpler with Sectors Made Simple. On behalf of myself, I'm sure my mom, and the entire team at Sectors Made Simple, we really appreciate you being here with us live, being a part of the Sectors Made Simple family, and we wish you all a happy and safe Thanksgiving, a successful Black Friday if that's your thing, and we'll be back in the following week with some exciting announcements for you all. So thank you all so much, happy holidays, and we'll see you all soon. Bye.